Today, we wanted to talk about asset allocation for the next decade and how we can position ourselves for structural shifts that are going to happen in the market as well as the economy. I hope you can see my screen and you can hear me clearly. If you have any questions, the format is going to be pretty much what we follow every week. So if you have any questions, feel free to type them into the chat box. There will be a dedicated segment for Q&A. And should you need anything else or you want to discuss more about the product, or if you have any other questions, feel free to drop that in as and when it occurs to you, right? So to begin with, I think we need to acknowledge that we are in a situation where fundamentally there are some structural themes which are shaping global as well as domestic markets. And this would essentially mean that we have to position ourselves better from an asset allocation perspective to capture these changes and ensure that we're managing risks effectively. So, first, I'm going to look at 3 to 4 themes that are actually changing. And the first theme that we're going to study is inflation. So, if we look at India as an economy, in the past, we had a very unpredictable inflation dynamic, meaning you had periods of extreme inflation, there was no price stability. And then around 2015-16, the RBI came up with something known as a flexible inflation targeting mandate. The idea being that if you had no price stability, that created a lot more policy uncertainty. And with more stable policy, you can actually achieve better growth and there are a lot of positive cascading effects in keeping inflation under control. That doesn't mean you want inflation to be at zero. It essentially means that you want it to be a more predictable macro variable rather than something that is always going to catch you by surprise. And so India's inflation target is actually at 4%. And if we see our last inflation print, that has been around 3.7%. Now, we're actually going to compare how inflation is playing out across the world. And if you look at how this is playing out, the Fed's target inflation is at 2%, but its current inflation is at 2.4%. And even based on the SCP, that is the Summary of Economic Projections, as well as other factors in terms of where policy members see inflation going, it doesn't look like you're heading to 2% in a hurry. The path to 2% inflation for the US economy is going to take a much longer time. And there are many factors which can actually disrupt the success to getting to 2% quickly. I think one thing which is capturing global headlines is, of course, what Trump is doing on the tariff front. Imposing high tariffs or counter tariffs could essentially create inflation within the US economy. They would be importing inflation, so to speak. At the same time, if the policies are going to be anti-immigration, you're also going to see a higher level of inflation coming through that because you will see wage inflation that kicks out because you would have to hire at higher wages. And then the third thing, of course, is what Trump has been saying about the Fed chairman, which is that he thinks that interest rates should be lower. So when you lower interest rates, you actually risk inflation going higher. You're also seeing the dollar lose value, and we're going to talk about that in detail because that's the second structural factor that we're really going to study. Then, of course, you have the Bank of Japan. In the Bank of Japan, again, target inflation is at 2%, but where you're seeing inflation is almost double. So you're seeing inflation at 3.7%, which is a bit difficult in terms of how they need to hike interest rates. But last year, when you saw Japan hike interest rates, you had this entire cascading effect in terms of how so you have inflation at 3.7%, and you know that essentially last year when Japan tried to increase interest rates, you had this yen carry trade unwinding, and then they realized that the yen as well as bond valuations was so interlinked with global markets that it needs to be done in a much more calibrated and measured manner. But if your inflation goes out of control, then you're definitely going to have to see some policy movement from the Bank of Japan. At the same time, if we move towards Europe, you're seeing both the Bank of England as well as the ECB look at lowering interest rates. So you've had the Bank of England's inflation be close to 3.5%, whereas the target inflation is 2%. Similarly, for the ECB, you're seeing lower inflation, and you've also seen that policy move towards lower rates as well. With China, of course, we have a very, like, this is the joker in the pack. While target inflation is at 2%, the Chinese economy is actually continuing to deflate or move into negative inflation. And that is a global risk because you're seeing a huge slowdown in the Chinese economy. You're seeing dumping. The response to negative inflation can actually be quite pronounced. The second theme that we're looking at is dollar depreciation. So if we look at where the dollar has been just in terms of its own relative value, right? We're not comparing the dollar to another currency. And this is measured through something known as the DXY or the dollar index. So when we look at the dollar index, what you're seeing there is at the start of the year, we were at 109, 110 levels, and today we're below 100, right? So you're at 99-ish, and there's been almost 11% depreciation from the start of 2025. And if you go a little bit further, I think even this month, it has been closer to 12 to 13%. So this is unusual for the dollar to lose so much value. And but there are fundamental factors that are, of course, triggering the revaluation of the dollar. So one, of course, today, everybody's looking at how leveraged the US Fed's balance sheet is, how much government borrowing they have, how much debt they have through trade deficits. And so as an economy, the US is quite leveraged, and there needs to be some response in sort of deleveraging those balance sheets. Second, of course, you've had higher inflation, you're having lower growth. Third, you've had agencies come and downgrade US debt, right? So, and you're also seeing more trade occur in non-dollar denominated assets, which essentially is showing that the dollar's dominance in global markets has come down, right? And it's moving closer towards what could be its fundamental value, but it is still, all of this being said, it is still a very important economic asset, and it is probably one of the largest currencies used in global trade even today. The third element we're going to study is how monetary policy is actually diverging. And we'll go through this bit by bit. So if we look at, again, the same central banks that we outlined first, the RBI has a neutral stance, and it allows the policy priority, of course, is to support growth today. It's not just about controlling inflation, because inflation on its own has moved into negative territory, at least on the food side. And you're seeing a slowdown in inflation or a disinflation that's occurring overall. At the same time, given where oil prices are today and the fact that even despite, say, a 12-day war that happened between Israel, Iran, and the US, you are seeing oil prices peaked out and they reverted back. OPEC is still looking at production cuts, which means that there's enough supply to keep prices stable, and that there is a need to look at, say, a different kind of approach to managing oil prices. And I think from our inflation basket, these are the two items that are essentially going to contribute or could create negative surprises. And where we are today shows that inflation is really not going to be a problem from a policy perspective. When we go further down, I think the main concerns that the RBI has, of course, are in terms of how geopolitical tensions are playing out. Because when you look at the risks that the RBI foresees, they talk a lot about global risks, right? So the domestic risks are underplayed because you have a decent amount of growth, even though it's not at target. You have a reasonable control over inflation. You are also seeing better fiscal management. You're seeing lower credit growth, of course, but bank balance sheets are healthy and liquidity in the system is now in positive territory, and the RBI is encouraging banks to lend more. And if we look at what the last rate cut action is, right? Then you're seeing that we cut interest rates by 50 basis points to 5.5% in June last year. In June this year. And this was a preemptive and large rate cut. So normally you would see this happen in incremental amounts of 0.25%. And this time you saw the RBI move in and issue this jumbo rate cut. And the idea is that they wanted to ensure that the rate cut is delivered in advance, that you're able to spur economic activity early on, and inflation is really not that much of a concern. While they changed the policy stance in June, the basic idea here was that they felt they could address any other risks that come up, which they're not seeing today. At the same time, they've also said that if inflation continues to go down, you would see more policy room open up in terms of cutting interest rates further. Whereas the tone that we get from the Fed is completely different, right? Their policy stance is more data dependent in the sense that they're very much in wait and watch mode, and they have been in wait and watch for a few years now, right? So even when inflation picked up post COVID, they were in wait and watch until they really saw inflation pick up, and then they started their interest rate hikes. And then you're still keeping 2% as your inflation target. But like I mentioned, you have different policy priorities that are actually all oriented towards pushing inflation up. And achieving that 2% target is going to be a real uphill struggle. And when we look at the concerns that the Fed has, your core inflation has been persistent. So it's not really coming down. Tariffs are creating a lot of uncertainty in the market. And while the Fed has been trying to reduce the balance sheet size and try to deleverage at some point, it is a monumental task, and it's not something that can be achieved in a quick span of time. Particularly if you're looking at recession risks, every time in the past, the Fed has been forced or the Fed has chosen the easier path of just issuing more government debt. And this may not be an option for the Fed anymore. So if you see how the Fed has been responding to data changes, they've been very much maintaining rates instead of looking at cutting them. And this has created some kind of friction and tussle between the Fed chairman as well as your president, who's saying that rates needed to be lower now and earlier, and it's just not happening, right? So the Fed actually is stuck between a rock and a hard place. And if we look at how the STP has changed over a period of time, you are seeing revisions to growth, downward revisions to growth, upward revisions to inflation, and upward revisions to unemployment. So this is not a very healthy policy mix, right? You don't want an economy that's slowing down, where unemployment is picking up and where inflation is picking up, because this can actually create a lot of wealth destruction at the household level. And you're also going to have a lot more difficulty in bringing inflation down, ensuring that people don't head into poverty. So all of this would be more problematic. Then moving on to the Bank of Japan, you have a more accommodative policy stance, and their goal is again 2%. This is, I think, most advanced economies are trying to keep inflation there. The policy concerns here would essentially be around tariffs, inflation, because inflation is not coming down, and the yen valuation. So we talked briefly about the yen carry trade and how the yen as well as Japanese borrowing costs are intricately linked to the global economy, and a lot of global portfolio managers have leveraged portfolios through borrowing in yen, and any hike in interest rate would essentially affect those portfolio valuations. It would also trigger like margin calls and repayments. So there is an entire financial system there that could be affected by any movements in the Japanese interest rates. So they have continued to maintain interest rates at 0.5%, but given that their inflation is picking up, there is a good chance that the Japanese economy would have to start hiking interest rates in this cycle. So it's a question of when rather than whether. Moving on to the BOE, you're seeing policy stance be restrictive, because essentially the big problem that most advanced economies are facing are along the inflation side. But you're also seeing central banks, especially like the Bank of England and ECB, who are starting to take a look at how growth is now slowing down. And there is a need to keep economic activity more stimulated and to work on job creation, right? So, of course, for everyone across the globe, this policy uncertainty around trade is there. And you are seeing the response in terms of more bilateral agreements being negotiated, in FTAs trying to get into place. And this is all in an effort to stimulate growth at some level. So while the BOE held interest rates at 4.25%, the ECB actually took a more proactive measure and they cut interest rates. And you're also seeing individual economies within the European Union. So if you're looking at, say, the Scandinavian economies, they've all sort of started cutting rates already. And lastly, with respect to China, like I mentioned, this is the joker in the pack. You are seeing a relatively loose policy stance because they need to stimulate inflation. They need to also increase credit supply because you're seeing a degrowth in terms of how the Chinese economy has been. And for them, price stability actually means moving prices back up. It doesn't mean bringing them down, because asset prices have already corrected in China, and there's a need to raise asset prices again to create some level of prosperity. If we look at what China's macro concerns are, they're basically worried about demand being weak, uh, not having enough prosperity within the economy, and of course, between US and China, there has been tariff uncertainty, but I think largely they have come to some kind of agreement where I think both parties are not entirely unhappy, right? So they have cut um, their repo rate in May to 1.4%, and they maintained this in June, which was seen as a positive move. So now that we're in a new era from a macroeconomic context, a lot of us hold on to legacy portfolios, and these legacy portfolios may simply not work in this new context. So, what is it that doesn't work in the legacy portfolios? I think first, they don't have a dynamic risk management capability. Most asset allocation models are static in nature. And this essentially is a problem because if you have been a traditional fixed deposit investor, you have earned maybe interest in the range of 6 to 7%. Um, and now you're already looking at much lower returns from fixed deposits. And there is a need to move into different asset classes that might be more tax efficient, more return friendly, and that support your longer term objectives. At the same time, you're also seeing a shift in terms of dollar valuation. So you have a new set of asset classes that could actually be performers. This can come in the form of commodities. If you're seeing inflation also pick up, then that could be a basket that could turn out to be interesting in terms of wealth creation. And a product that is able to dynamically manage risks, right? Meaning you have the flexibility to move within asset classes, across investment ideas, as opposed to pockets that are brought together and form a portfolio. Then you need to have a much more strategic view of your assets. You need to have a overall like a bird's eye view in terms of how your assets are placed, where they're allocated, how you need to scale those things up, versus also being able to look at the micro levels of what you need to do. So these static asset allocation models and the ability to dynamically move from one risk level to another risk level to address the macro risks that are relevant today is highly important. Uh, and when we look at adaptability, right, many products or portfolios don't really have that ability to adapt to the context. And adaptability comes from certain leanings in terms of philosophy and product construction. That is, how are you able to address inflation within the portfolio? How are you able to address the fact that the dollar is weakening? How are you able to address that the global economy is slowing down and India is growing at 2x that pace, right? So most legacy portfolios are macro vulnerable, and that is an important factor that we need to address. So one way to build macro resilient portfolios is to have some level of smart diversification. So, what can we do to create better portfolios that perform in this changing environment? I think the first thing that we can look at is through asset allocation, because asset allocation would essentially mean that you have lower correlation between the asset classes within a portfolio. And this is a very beautiful mathematical way to manage portfolio risk, because when you have lower correlation within asset classes, you actually tend to have performance in a wider range of scenarios. You also tend to have lower drawdown. So it works out both from the perspective of returns as well as risk management. And it may sound too good to be true, but that's essentially how it works. The second way to make your portfolio macro resistant is to follow a more bottom up approach to investing. So you're looking from a company perspective and then working up to see how it plays out. So you're essentially looking at what a business can do, and when you're looking at the fundamentals of the business, you're actually trying to protect the portfolio from macro shocks. And this can also be macro proofing, because with the right kind of asset allocation, you may be able to play a different set of scenarios. So, for example, your precious metal basket may not really perform very well in a low inflation era, but can do reasonably well as inflation changes, geopolitical relationships change. So when all of this happens, you might actually see a better level of performance from this asset class. At the same time, you might also be comfortable looking at a duration call, or you might look at commodities, which could all play out like in each macro situation. You might see something play out very differently. At the same time, if you're looking at equity and you are in a high growth economy, this could be something that continues to play out really well. Now, we also need to look at tactical asset allocation. So, strategic is along the lines of having a fixed amount in each asset class. So, we talked about static portfolios. So, static portfolios tend to have a more strategic nature. And you see, say, a family office might say that they have an allocation of X% towards precious metals, Y% towards equities, and so on and so forth. So they may say that so much of the portfolio needs to be in passive investments, so much of the portfolio needs to be in active investments, and you have all of that play out. But when you're in a transition point for a macro state, then there is opportunity to look at asset classes from a more tactical perspective rather than a strategic perspective. And this tactical approach to asset allocation gives you more flexibility in the future, because you will be entering and exiting. And when you do that enter and exit, you obviously create some liquidity to participate in the next set of ideas. So investors really need to look at how to diversify their portfolios in effective and smart ways, such that they're not macro vulnerable. They're taking advantage of opportunities that are there today. They are future ready in terms of liquidity as well. So, what is the approach that we follow at Sphere? We run a multi-asset portfolio management service called Sphere. And when we look at how Sphere is constructed, there are three things that we look at. So we have tactical decisions, we have the core portfolio, and we have thematic plays. Now, when we look at the core portfolio, we're always looking at quality. We're always looking at stable companies that can continue to deliver performance for investors. There's a very tight buying discipline in terms of valuations that occurs here. You are looking at participating in specific ideas in very tight ranges. This ensures that when we are sticking to a value philosophy, it essentially allows investors to be protected from the downside, because we're buying only at fair valuation. And if we see prices go further down, then that actually becomes a very, very attractive buy zone for investors. then it also protects you from these losses, but it also allows you to capture the upside, right? So if you're very tight in the buying discipline, then the potential to make more returns also improves. So this is where you get that additional return from. It comes from a disciplined approach to participating in ideas and a disciplined approach to managing risks from a valuation perspective. Uh, so the core of the portfolio is always going to have that quality perspective. It's always going to have your valuation discipline. That applies to even the tactical as well as the thematic ideas. Now, thematic ideas actually work out from a cyclical basis. So just like we don't think that there is any bad asset class to own, there is no bad theme to own. It's only about getting your timing right, understanding the triggers for what could make a theme perform going forward. And themes are played in interesting ways within the portfolio. So, where we're looking at specific outperformers, we might choose to opt for stocks or specific financial instruments. Where we see a broader thematic play, we might even look at a basket approach, which could include, say, a mutual fund or even an ETF within that portfolio. And some of our best performing investments in the past. So when we looked at, say, PSU as a theme, a few years ago, that played out very well through the ETF as well as the mutual fund approach, because that basket in itself is very diversified, right? So if you're looking at a public sector undertaking, banks get classified within that. You have capital goods companies that are classified within that. You have uh, infrastructure-based companies that are classified within that. So if you're looking at PSU, if you wanted to build that position through ideas, stock-specific ideas, the entire portfolio weight would have been fairly skewed. But if we built it through the basket approach, that actually worked out really well. And that has, so there is a very interesting approach to creating these thematic plays within the portfolio. Whereas if we look at say one of the core themes in Sphere, which has been banks, the private bank theme we have played through stock specific and not with the index. And I think that stands out because when we look at the index, you do see ideas that could drag on performance within the index. So the level of product research that goes in and product selection that goes into into Sphere is actually much, much superior to what you see within the industry. And coming back to tactical, I think tactical is always about getting your asset allocation right and moving with the macroeconomic situation so that you're able to manage those risks effectively. And this is something that we've been able to do. So if we look at, say, what was Sphere's allocation to equities towards the end of 2023 and to start of 2024, we actually had a fairly high allocation to equities because we felt that was a performing period. And through 2024 and 2025, we've really brought that equity exposure down. So I think in start of January last year, we would have been close to 80% in terms of allocation. And by the end of 2024, we were closer to 67, 70%. And today we're again around 65, 66% in equities. And the nature of the equities in the portfolio has also become more defensive. And you are seeing something that is working towards an environment where you're seeing India's economic growth slow down. You're seeing a more inward approach in terms of allocation, so that we're looking at domestic focused companies that are not going to be subjected to these shocks that can come from tariff policies, right? So this kind of tactical move happens periodically, and it is this is the way in which we're able to manage risk dynamically. We're able to ensure that investors have a smoother experience in terms of how they are performing. And I think the outcomes are also shown in the numbers. We'll, of course, look at our performance later on. And let's talk about the use case, right? In terms of who is this product for? Yes, we're a SEBI registered PMS, but what who benefits from investing in a product like Sphere? I think the first, of course, obvious use case is in terms of family offices, because if you have this piecemeal approach to asset allocation where you're buying different products in different places and then trying to consolidate, then you don't really have a good control over what your asset allocation really looks like, right? And you're not able to measure with ease which decisions played out well. You have to compute your individual returns and standardize them to one timeline and then look at things. But with an asset allocator product like Sphere, you compress this entire thing into one line item in your balance sheet. And while this works for family offices, it also works for individual investors who are keen on having a little bit of a flavor of everything. The idea being that what we tend to do, of course, is we might own some bank FDs because the rates were good. At that point, we might dabble in some foreign equities because it seems like an exotic investment to have, or you see some merit in diversifying geographically. Then you might own a certain amount of stocks, you might have some SIPs running, and all of these things are in different places, and you never really measure which ones are working for you and how they're working for you and whether they're relevant to today's context or not. So, keeping that in mind, I think Sphere really simplifies this decision making process, and it allows an investor to remove this worry of, like, is this the right time to invest? Are markets expensive? Do I need to be scaling up now? And it just allows you to stay, right? When you have the money, you can trust that you can put your money in this product and it is going to work for you. So that's the problem that Sphere really tries to resolve. The second thing that it does is that it really helps people who are saving for retirement. Now, in India, a lot of the automatic retirement savings are heavily focused on fixed income. And as you all know, this is not something that can really help you compound wealth at a decent rate, and it's not something that's always going to beat inflation. So whether it's your provident fund, whether it's the NPS that you're doing, or the post office savings schemes that we have, or gratuity, all of these are predominantly fixed income investments. NPS, of course, is a beautiful way to get your asset allocation right, because if you opt for the choice where you can decide the asset allocation, you can do pretty much what we're trying to tell you to do in terms of dynamically managing the risk. But if you choose the auto life cycle option, it tends to be more oriented towards a conservative investor's risk profile. So you are going to see a higher allocation to fixed income earlier in your career. So with the allocation to equities as well as other asset classes, you're essentially able to compound wealth in the range of, say, 10 to 12%, which is excellent in creating some retirement wealth for yourself. Right. And again, this is something that you can build paycheck to paycheck, or if you're an entrepreneur on a quarterly basis, you can contribute and set aside something for your retirement. Specifically because if you're an entrepreneur, you don't really have a lot of these automatic savings kick in, right? If you're a salaried employee, at least your provident fund is something where both you and your employer are contributing to. So there's a good chance that even from a contribution perspective, you have some kind of financial security rather than from a compounding perspective, right? Lastly, I think because this is a multi-asset product, you can actually do treat Sphere as a goal-linked wealth creation tool. So if you're somebody who's looking to buy a property at some point, if you're someone who's looking to educate your child, or you have any other specific goal, you can treat this as a one-stop solution for that goal that you're trying to fund. So now I'll just quickly walk you through the terms of the product. I think the terms are here. I'll come back to the performance. So if we look at the terms of investment, your minimum is 50 lakhs because we are a SEBI registered PMS, and that minimum amount is mandated by SEBI. Beyond that, our benchmark is the NSE Multi-Asset Index 1. There is no exit load on this product. So anybody who enters is free to leave the product whenever they want. That can be under a year, over a year. But ideally, we would recommend that you stay within Sphere for 5 to 7 years. That will give you a flavor of how an entire asset cycle works. And that I think that experience can be quite good for an investor. What is our fee structure like? We have a flat fixed fee of 1.5% on the daily average AUM. This is recovered on a quarterly basis within the portfolio, so there's no additional transfer that an investor has to make. Any other expenses? So, of course, there is a custodian, there are transaction charges, all of this will be at actuals. And over and above that, you, of course, have GST, which kicks in. So from a suitability perspective, I think anyone with a moderate risk appetite, and we did talk about some use cases for Sphere, and ideally, I think the investment horizon should be around 5 to 7 years. But of course, given that there is no exit road, it is up to an investor how long they want to stay within the product. We have a very flexible asset allocation model, which allows us to go 0 to 100% within any asset class or instrument that we have. The only restriction that we have is in terms of single stock exposure, where it will not cross 25% of the total NAV of the portfolio. All right. So coming back to performance, sorry, I have to go back and forth in this, but I hope you can forgive me for that. You can clearly see that Sphere has been fairly consistent in outperforming all the benchmarks that it's set on a longer term basis. Our 1 month, we are not too bothered by 1 and 3 and 6 month performance because we don't think these are timelines that you need to really measure a portfolio performance. Even 1 year is not really like a long enough time period for you to measure, but you can see that our 1, 2, and 3 year performance, as well as since inception, we have beaten all of the benchmarks by a wide margin. And this is important from an investor standpoint to kind of figure out what kind of product they want to be in, right? So these are our performance numbers, and I think we are fairly confident in terms of being able to beat our benchmarks, but we don't try to chase and outperform the benchmark on a short-term period, because the entire orientation of Sphere is on a long-term basis. If I'm telling an investor to look at an investment horizon of 5 to 7 years, then we have to have a similar expectation in terms of how we view ideas within the portfolio, right? We don't do a lot of churn, we don't do a lot of trading, and we are very tax conscious. Of course, any exits that we make would trigger a capital gains for the investor. So while we're cognizant of these things, I think the most important thing is that we have a long-term orientation. We do look at ideas as something that can be built over time, and performance comes in through the discipline that we follow on the valuation side. While you have seen these stellar kind of returns since inception, I think it's important to understand today's context and anchor our return expectations lower than what we've been able to deliver in the past. And we would look at, say, a 10 to 12% as the compounding range going forward. So how do we keep cool through turbulence? If we want to look at how drawdown data is, you see that we have a larger drawdown than the multi-asset index that we benchmark against. So while the benchmark index was at around 8%, our drawdown has been closer to 11%. But we have out of in terms of drawdown, we stand above the Nifty, right? So if you look at the Nifty's drawdown, that has been closer to 16% in this time period. So beyond March 31st, we've not had a larger drawdown. So that's why the data reads that way. And the basic idea is that you want a portfolio that can perform. So you have better upside capture. At the same time, you want a portfolio that's more resilient, so you have lower downside capture. So I think the data clearly shows that Sphere is able to deliver on both of these fronts, right? So moving on, this is again our performance data as well as the asset allocation. So as you can see, we're about 65, 66% in equities. We have a reasonable exposure to global as well as fixed income and precious metals as well. So this is an introduction into our entire team. So we have 4 other products in the PMS universe. So we have Solitaire, which is a pure flexi cap fund. We have True Blue, which is a pure blue chip fund. We have Vriddhi, which is focused on small and mid caps. And Sphere and Neo are our multi asset funds. Neo is caters exclusively to NRIs. So how can you engage with ithought going forward? Of course, you could look at one of the products that we have on service. If you're not looking at a 50 lakh minimum ticket size, then you can, of course, start looking at our Milestones to Wealth program, where we help investors go from where they are to their first crore in savings. And if they're already at the 1 crore milestone, then we take them to the $1 million milestone. And if they're at the $1 million milestone, there's more that we can achieve. So there's a lot that we can do in terms of how we're engaging with investors. If you're not somebody who's really looking for an investment solution, then you can join our Learning Saturday initiatives, which are essentially webinars like this, where you can interact with our team, try to understand what's happening in the markets, and maybe find something that works for you. I will also quickly leave our contact details so that you will be able to reach out to us in case you want to take this engagement forward. And I'd also like to thank everyone who's been part of this webinar today. And I know some of you may be investors. So if you are an investor or if you've interacted with us on multiple bases and you have something to say about the way that we work, I would request you to please leave us a review on Google. This would help us get more visibility from investors like you, and we would be very happy to engage with you. If you have any feedback for us, please feel free to either drop it in this chat, write to us at 9500027285, or if you feel more that it will be addressed in a better way, you can also leave it on the Google review. We'll be very happy to take your feedback and really work through this and create a better outcome. The goal is that we want you to feel very comfortable with the way that you are in this ecosystem, and anything that we can do to help you or help other investors just like you would really help in terms of what we want to achieve and the kind of impact that we want to create in the world. All right, so I already see a few messages on the chat and I'm going to start taking these. But if you do have questions, please feel free to keep typing it. We have about 15 minutes for Q&A, so I'll be happy to take this forward. All right, so the first one is about inflation. Yes. So I think obviously one thing that you need to understand is that the inflation basket is not representative of your expenses, and that is a separate debate in itself. There is a high allocation to food, items that you may not even use on a day-to-day basis, and that is representative of what they think rural India slash most of India has. That's a separate debate. Of course, I'm not a policymaker. I'm not responsible for the inflation index. I do think it is a bit flawed and not as practical as it should be. But you have to have some benchmark that you work with, right? I think that's where the logic comes from. Really missing something because inflation is really 3.7%. Then why do we need MFR equities and simple FDs is more than enough. So I think you're looking at a pre-tax return, right? So if your FD is at 6%, you're paying 30% tax. There is a need for investors who are in that tax bracket to look beyond that simply because it's not tax efficient. And you also want to create wealth. And while today's inflation is at 3.7%, it could move to 5%, 6%. Then a 7% FD is really not going to cut it for you. And you also want to create more wealth because there are people who are not just looking to live within their own generation, they might want to pass on assets from a legacy perspective. I think Sphere AUM is above 670 crores today. If 3-year performance of Sphere is 30%, X amount invested is grown 30% or 30% for 3 years. 30% for 3 years. So that's like a compounded rate. So it would have been 30% year 1, 30% year 2, 30% year 3. But like I said, this is not the representative benchmark. You should be looking at 10 to 12% in terms of a compounding return. I hope this question has been answered. I can take you back to our slides so that you can see the split, but it's about 66% in equities, about 10% in debt as well as global investments, and about 13% in precious metals, and about 1.5%, 2% in cash. Okay, I have a concern on its higher returns because the benchmark itself is only a monthly allocation, and how come your fund can deliver so high unless you guys have taken undue higher equity exposure risk or short? Because just a higher CAGR alone doesn't mean it's better or best, because multi-asset funds per se is not supposed to deliver so high. Can I just ask you a simple question? What do you think was the best performing asset class of 2024? You can just type your answer in the chat. Yeah, it's actually silver. Nobody had allocation to silver. We had a very high allocation to silver in the portfolio. And of course, I can't share this data with you, but our performance is broad-based. We don't have one or two winners in the portfolio that have delivered high returns. I'm not deviating from your question. I'm trying to answer it in a different way. It's not only because we've taken equity exposure. I've actually reduced equity exposure. You've been attending every one of our webinars, and you have seen month on month how the equity exposure has changed. So when you look at this, you have been very early in certain themes. We play a contrarian nature, which essentially means we enter early, we exit early, and you're able to deliver higher returns through that. We don't see only equities as a wealth creating asset class. We see merit in owning other asset classes as well. So I don't think it's because we've taken a higher exposure to equity. And you can, of course, continue to track our performance and see how we're doing going forward as well. Is the opportunity very limited now in Sphere? Because the top of amount which I am adding for the last 3 months mostly goes into dying debt funds. Are we waiting for the right opportunity? So, like I said, our basic approach is that we don't see any asset class as being not worthy of being owned. We are looking at scaling up where we see relative value, right? And in fixed income, we see a lot of relative value today. You are seeing that your interest rates have room to move down. You are seeing that transmission still has to occur on the duration side. At the same time, equity markets are getting heated. You're seeing a lot more flows going. So FI outflows have been happening in debt, FI inflows are happening in equity, and you're seeing a lot of money chase a set of stocks. So within that, we are trying to be very defensive. So if you look at your portfolio construct, you will see that the nature of your portfolio has changed. And you will see, I think the idea is if you participate continuously in a product like this, you will get exposure to different asset classes at different points in time. Yes, so any returns that I showed you are post fees, right? So it is post fees for the mutual fund, it is post fees for the PMS as well. I'm not showing you pre fees for the PMS and then post fees for the mutual fund. The fee structure is included in the performance data itself. As of now, global exposure is through funds or ETFs. There are only a couple of funds that are oriented towards global debt. At this point, given how fundamentals are of, say, advanced economies versus India, Indian debt has a much better valuation than global debt. So please follow us on YouTube. We're at ithought Connect, and you will see the recording go live there over the weekend.